Welcome to the Explainer. We are jumping right in today because we have a truly massive topic to cover. We're diving deep into a fascinating breakdown from AIforbusinessbanking.com, looking specifically at how to re-architect business banking using artificial intelligence. And today, we're putting a magnifying glass on a really sensitive area, the new science of credit decisions. So let's just get into it because what we're going to uncover today will fundamentally change how you view AI integration in finance. We're taking a hard, critical look at how we're actually using these powerful tools in business banking and why the path that most institutions are currently sprinting down might actually be leading them right off a cliff. Okay, listen to this quote. Automation isn't the goal, judgment is. Seriously, let that sink in for a second. Across business banking right now, successful AI has quietly, almost secretly, become a synonym for fully automated. But that is a highly, highly dangerous myth. 100% AI automation is absolutely not the ultimate finish line. If you think automation is the end goal, well, you're building Carta engines that are incredibly fast, they're perfectly consistent, and they are completely wrong in ways that literally nobody will catch until it is way too late. The author makes a really powerful argument here. Automation is simply a means to an end. The actual end product we're trying to manufacture? Human judgment. So here is our roadmap for today. We'll start with the wrong finish line, then detail the 4 stages of AI. After that, we'll explore the Centaur effect, discuss where to draw the line, and wrap it all up with 3 priorities to act on. Starting with Section 1, the wrong finish line. Picture a typical bank strategy session. Someone draws a straight line on a whiteboard going from manual underwriting straight to AI-based underwriting. But that straight line is fundamentally flawed. Let's look at other really high-stakes industries for a second. Take aviation. They didn't just fire the pilots when automation matured. No, they built decision support to handle the mechanical stuff so pilots could focus on making the tough human calls. Radiology did the exact same thing. AI flags the anomalies, but the doctor actually signs the read. Credit decisioning, though, it's drifting dangerously toward decision replacement. We are blindly celebrating every little percentage point of straight-through processing without stopping to ask what type of decision we just carelessly automated away. And here is the scary part about what happens when you fully replace the human. Fully automated AI entirely removes the layer that was built to catch what the model cannot see. This is the quiet risk hiding inside most SME credit books right now. Think about it. A model can approve a loan in under a second. Boom, done. But it absolutely cannot tell you why an applicant's revenue suddenly dropped in March. Why? Because nothing in its training forces it to ask the question. A fully automated model might approve a loan today and completely miss a subtle covenant breach that a human relationship manager would have flagged on day 1. So instead, that breach just goes unnoticed. It quietly compounds across other linked accounts until a massive financial loss explodes 18 months down the road. Moving on to Section 2, the 4 stages of AI. This brings us to the absolute core of today's explainer, detailing the 4 stages of AI credit progression, from automation all the way to judgment. This is a super useful progression to understand. First up, we have automation. This is just basic extraction. AI reading financials, pulling bureau data, maybe flagging missing documents. It's highly repetitive, mechanical, and genuinely low stakes. Next is assistance. This is where the model makes a recommendation and a human confirms it. It definitely speeds up the cycle time, but honestly, it's still just a faster version of a manual review. Now let's slow down for the really big ones. Stage 3 is augmentation, where AI starts revealing hidden patterns. And finally, Stage 4 is judgment, where the ultimate focus is on decision quality, not decision speed. Let's look a bit closer at how we define augmentation, because this is where the real magic happens, and tragically, it's exactly where most institutions stop investing, way too early. Augmentation happens when AI surfaces things an underwriter would need hours or maybe multiple lifetimes to notice manually. Imagine a subtle, seasonal cash flow pattern spread across 3 linked accounts, or maybe a supplier concentration that only becomes visible when you stitch together transaction data from 2 completely different systems. The underwriter isn't just moving faster here, they're seeing something they literally could never have found by hand. A lot of banks mistake assistance for augmentation because, well, they both just look like a model output and a human sign-off on a dashboard. But the difference is massive. Assistance is just a passive sign-off. Augmentation requires active reasoning about a complex pattern. If you're only measuring success by how fast your cycle times are, you are going to completely miss this distinction. And that naturally leads us right to the final stage in the progression, judgment. Judgment decides when a rule shouldn't apply to a specific borrower in a specific quarter. It's the ultimate destination that those other 3 stages exist to serve. Section 3, the Centaur effect. You know, the competitive chess world actually settled this AI debate years ago. In what they call centaur tournaments, a human paired with an AI engine consistently beats the absolute best AI engines playing completely alone. Picture a grandmaster sitting there with a computer. The human doesn't win because they calculate better than the machine. No way. The human wins because they know exactly which of the machine's suggestions to trust in a given position and when to boldly override them. Neither the human nor the machine wins consistently by itself. The pairing does. And credit decisioning follows this exact same pattern. A model's incredible pattern recognition, paired with a human banker's contextual judgment, will consistently outperform either one operating alone. The goal is to hand the human better material, cleaner signals, fewer blind spots, so they can make the ultimate call. Let's get into Section 4, Where to Draw the Line. I want you to imagine sorting your decisions into two distinct buckets. In the first bucket, we have mechanical tasks. We're talking formula-driven ratios, missing document flags, that kind of thing. Completely automate them and never look back. But in the second bucket, we have judgment tasks, marginal approvals, first-time relationships, exceptions made for a highly stressed sector. You must fiercely protect this bucket. Do not quietly automate these away just because some software vendor promises you a higher straight-through processing metric. Let me give you a quick story to make this real. Imagine a 5-year relationship with a small business, and their sector just entered a mild downturn. The massive divide in context here is so clear. The financials might still clear every single automated ratio, so a model trained only on numbers, it will renew that loan without hesitation, because a model cannot distinguish a temporary sector wobble from the early stages of a total structural collapse. But a human banker, a banker who has watched this specific sector for a decade, they know exactly which one it is within the first 5 minutes of a conversation. That distinction is pure judgment, and no amount of additional automated data is going to resolve it, because the signal that actually matters here was never going to show up as a math ratio in the first place. And just to be clear, this isn't exclusively a credit problem. Anti-money laundering, transaction monitoring, and treasury liquidity models face the exact same divide. An AML system can clear every automated rule and still completely miss transfers that were intentionally restructured to stay just a few dollars under a reporting threshold. A treasury liquidity model might flag a cash position as totally fine, while a human treasurer immediately recognizes a bizarre change in client behavior that the model literally has no feature to track. The rule check is automated for sure, but the pattern judgment has got to remain firmly human. Which brings us to our final section: 3 priorities to act on. First, we have to address the elephant in the room, the job nobody designed for. If a bank treats AI integration purely as a headcount reduction exercise, they are in for a devastating wake-up call. Think about it. The relationship manager who used to spend their entire morning manually rekeying financials is now going to spend that same exact morning adjudicating the hardest, most complex and ambiguous cases the model couldn't handle. That is a significantly harder job. It requires way more judgment per decision, not less, because the easy decisions are completely gone. So leaders, if you staff this judgment tier with whoever is just left over, your credit book will show massive losses within a year. You have to treat this as a complete role redesign. So here is your summary of actionable steps, the 3 Ds, if you will. Number 1, draw. Draw the line between mechanical and judgment tasks before you automate a single thing. Number 2, design. Design for decision support, just like the aviation industry, not decision replacement. And number 3, document. You must document every single human override. Explainability isn't just a nice-to-have feature, it's a strict regulatory requirement. A banker's disagreement with a model has to leave a defensible record. A credit decision that can't show exactly where human judgment confirmed or overrode a model isn't a defensible decision at all. It is just a probability with a signature blindly attached to it. I want to leave you with this powerful, lingering question today. The banks that win this decade will not be the ones that automate the most credit decisions. They will be the ones who can answer this. Can you say with evidence exactly which decisions you chose not to automate and why? I hope this challenges your current roadmap and leaves you eager to rethink how you partner human insight with AI power. Thank you so much for joining me on this explainer. Keep asking those hard questions, and I'll see you next time.